Hi, and welcome to We Got Your Back Taxes. My name's Jeffrey Schneider, and I am an enrolled agent. Today we have with us James Cioffi. He is an attorney here in Palm Beach County, and one of the things he specializes is in estate and gift taxes. Welcome, James.
Thank you.
So we're going to talk about, the first step is we're going to talk about gift taxes.
Yes.
And that seems to be what most people are concerned about when people give gifts and what do they have to do for tax-wise.
Yeah, many of my clients are concerned about their children, and they want their children to receive the benefit of some financial contribution while they're alive rather than waiting until they die. So they need to be aware that it's a $14,000 exemption, that they're allowed to give $14,000 to any individual. In fact, it doesn't just have to be children. So you can give $14,000 up to $14,000 tax-free to friends, relatives, etc. Also, some clients want to hold a mortgage for their children, and they can forgive $14,000 of the principal each year, which is another interesting tool that they utilize, so that they can hold the mortgage just like a bank would hold the mortgage, and then each year forgive $14,000 of that balance of the mortgage. So depending upon the amount, it could be a sizable amount each year that they're gifting, and the principal keeps going down.
My audience needs to understand also that when you say tax-free, there's also that exclusion, isn't there? That you have a lifetime gift that is also tax-free, but you don't have to file a return.
Correct.
If it's the $14,000.
There's a lifetime exclusion of $5,430,000 this year. It's interesting, when I started practicing law years ago, it was about $600,000. So most people incurred gift tax at that point, but now very few Americans are experiencing it because of the high unified credit that amounts to basically $5,430,000 tax-free.
Now that $14,000 is for an individual. What happens if it's a husband and wife, or two grandparents want to give? My grandparents want to give me more than the $14,000. Can you do more than that?
Well, the beauty of it is that each person can give the $14,000, so both parents can donate the $14,000. And if you have multiple grandchildren, each grandchild can receive the $14,000, or as I said, any individual can receive the $14,000. And
one thing you have to remember is that not $14,000 any one time, is throughout the year. So say, for example, you give $10,000 in cash to your child, but then you decide for high school graduation you buy them a car that's, say, $8,000. Well, you're thinking, well, both are on the 14. It's not. It's
correct.
Through the year, and then you're going to include birthdays and
right.
And that's where you can get really screwed up if you don't count all that.
And it's the calendar year, so
right.
It's January 1st until December 31st. Also, you can gift assets. So if you have a stock that you wanted to gift, and this becomes interesting because if you anticipate an increase in value, it might be better to gift it now at the lower value. So you can gift tangible property, or you can gift stocks, bonds, anything like that, any type of investments.
All right. And what happens with that gift of things as opposed to cash? If the person wants to sell, say, my grandparents give me 100 shares of Microsoft, and then I want to sell it. Can I sell it? Is it mine? I mean, do they give me?
Yes, they actually transfer the stock certificates to the beneficiary at that point in time. Okay. So then you take possession of the stock, and it becomes yours.
Okay. And one bit of tax advice. As opposed to an estate and a gift tax, you pick up what we call the basis of what the person gives the gift. So, for example, my grandparents bought IBM in the 1950s. It's probably worth about $4.
Right.
Now it's worth 100 and something. So if you sell it, you have a capital gain. But if you give it to the children, they're in a lower tax bracket.
Right.
Am I correct on that?
Correct. Yes.
Okay. So you have to be careful of how you handle these gift taxes. What else on gifts that we have to worry
why
about?
we want people to consult you, Jeffrey, because you can give them guidance. And that's why you're such a valuable person to know. The other thing you want to think about is estate tax, too. They work hand in hand. So some people decide not to gift a certain asset because they want to get the benefit of the value at the time of death rather than before. So, for instance, if a person owns that share and they sell it while they're alive, there would be a capital gain, whereas if they wait until they die and they gift it, the heir gets the benefit of that property at the value as of date of death.
We call that step up.
Right. So just for the public to understand, some assets you would really want to keep, and then it would be part of your estate rather than gifting while you're alive. Once again, consult Jeffrey about that to be sure that you're taking the right steps at the right time.
Now, you mentioned that estates and gifts work hand in hand, and you mentioned before this year $5,430,000 of exclusion that you can exclude that amount of the gift. But how does that work on the estate? Say, for example, for all these years, I contributed X amount of dollars. What happens between that exclusion? Because that's also the estate tax exclusion, too.
Right, right. There's also the estate tax exclusion, which is $5,430,000. So it's great that you have that ability to shelter that amount of value of your assets upon death, in addition to the gift tax exemption.
And what happens to those gifts that you gave all along? How does that work with these? Because you don't get $10,860,000, you get $5,400,000 together.
Right. So what you would do is have to keep track of the gifts that you have given throughout your lifetime, and then the difference is what you have available at the time of death.
Now, since you don't file a return for that $14,000, if I give my grandchild 10 years, $14,000, back then sometimes it was $10,000, but let's just say that's $140,000. Do I have to reduce, even though I didn't file a return, of that $14,000, or it's only when I give over? How does that work to reduce the exclusion?
The actual act of gifting the asset is part of the exclusion.
Okay.
Yes.
Whether you file the return or not.
Right. Right.
If you give more than the $14,000 out of a joint account, your spouse has to, and there's a term for that.
Well, out of a joint account, both if it's a joint account, then $28,000 can be given out of that account.
Do you have to file a return to make an election or anything like that?
Yes, you'd have to designate which is the $14,000 for each,
from each one,
or what amount from each person is being gifted.
So that's something you need to make sure that you're willing to give. You need to speak to an attorney before you do it, because we have a saying, we can't undo what you've already done.
That's true.
So you need to talk to somebody who specializes in estates and gifts before you actually do the gift. Let's talk about more on the estate side now. It's only for people that are worth $1 to $2 million at this stage. There's something called portability, and it doesn't affect a lot of people. When the law changed a couple years back and they made it now permanent, we have to be careful, because now people are saying, well, I'm not worth the $5,430,000. My wife and I together, and we're never going to make it. But what happens if you win the lottery? Nobody thought they're going to win $538 million. How does that term portability work?
Well, you do want to document exactly what amount is being valued at the date of death of the first spouse, so that the second spouse that dies is able to calculate the difference for portability purposes. So, for instance, if you do win the lottery, you want to make sure you get the full advantage of your $5,430,000. Plus whatever amount your spouse didn't use. So you would document that for portability purposes. Now,
the spouse, you said what the spouse didn't use. The spouse, when you inherit from a spouse, you don't use any of your $540,000 because it's an unlimited exclusion.
Right.
So now you have $10 million of exclusion.
Right.
Okay. So, like I said, the best thing to do is have a plan in place, speak with an estate attorney, make sure you have wills and trusts, and we will have an attorney coming on a future show talking about wills and health surrogates and getting to that side of things. But you need to talk to somebody before the spouse dies. In the little time we have left, James, tell us how people get in contact with you.
My office phone number is 561-747-6000. My email address is james@jcclaw.com. And I'm the traveling attorney. I come to visit clients all over the county.
Oh, my God.
If they're not able to come to my office.
That is amazing. Well, we thank you for joining us. And we also can look at our website at www.sfstaxaccount.acct.com. And I work closely with attorneys like James doing the estate plan and seeing how the tax ramifications work. We all file the tax returns, and even if you don't think you need to file one, you should see somebody like James to make sure what's happening now.
Definitely want to work with a tax planner and your attorney, because we do work in conjunction with each other, and it's beneficial to speak to both of us.
And now in the law, when you're filing a return, an estate return, it's required that all the beneficiaries know what the value is. So you know to step up, and you know when you sell some of these assets you inherit if you have any tax consequences. Is there anything last bit of wisdom on the state of gift tax side?
Well, your life circumstances change, they say, basically every 3 to 5 years, so it's wise to review your estate plan periodically and don't assume that whatever you planned is fine in perpetuity. So I would recommend that you do review that and then speak with your tax planner and your attorney at least every 3 to 5 years.
Okay, well, thank you for joining us, and We'll see you next time. See ya.
Thank you.